So let's get started talking about support and resistance, or the floor and the ceiling of an elevator. Now, support and resistance are one of the most widely used concepts in Forex trading. Strangely enough, everyone has their own idea on how you should measure Forex support and resistance. The concept of support and resistance forms the basis of most technical analysis. Traders look to buy at or near areas of significant levels of potential support in an uptrend or potential resistance in a downtrend. So, in other words, these are the floors and the ceilings above and below price. Remembering whether there's support or resistance isn't so important. I intermix the terms all the time, except I know exactly what is happening when the price is supporting something or the price is reaching a resistance, because in a downtrend, okay, it is resistance because price is coming down trying to fall, and when it hits that specific level going down, it has a difficult time falling through there, so it's making it the resistance. Where in an uptrend, it's supporting the price while it's trying to push the price up to the next highest level, and when it reaches that next highest level, it reaches resistance. So the easiest way to imagine this is if I put you in an elevator and you wanted to go up in that elevator, the floor under your feet was supporting you, and you had to break through that ceiling to reach the next floor. Once you do that, that ceiling becomes the floor under your feet, and you have to go through the next ceiling or the next significant price level. When that elevator reverses and is coming down, that same ceiling is now your floor, and it's also what is the floor is your resistance that your support, because you have to break through that floor to get to the next lower level. So resistance acts as a ceiling capping future price movements, and support acts as a floor supporting future price rises. Now, resistance is not just some random area. Now, support and resistance are not arbitrary random areas that you just see, there's a number on the chart. There are many different levels, or not levels, but there's many different support and resistance prices that can be achieved in different ways, but they're not arbitrary. You have things like a moving average line. If the price is above the moving average line, that moving average serves as support. If you're using a trend line and price is rising up, that trend line can work as support. But then you also have eyeballing. Look at historical prices, where historically prices had a problem at a specific level. Then you have things like pivot point calculators, which are mathematical calculations that give you support and resistance. Then you have indicators like Fibonacci levels, okay, which go on your chart and give you a different support and resistance area price. But all of these are significant. Okay, now we have major and minor ones, but you can decide which levels you want to make as support and resistance. But if the easiest way to understand these is as price is moving up, remember in an uptrend, price is making higher highs, then higher lows, higher highs and higher lows, higher highs and higher lows, higher highs. So we could extend that point where it made the lower high forward, and these become support and resistance levels. So each one of these pushes and eases, pushes and eases, pushes and eases, push, ease, push, ease, push, ease. Okay. Because the only important support and resistance zones are the ones around the current price. So these down here aren't going to help you with trading up here. Now, they'll help you if the trading starts to fall down to that level, because then you might expect it to at least hem and haw at this level. What you're doing is you're developing steps on a ladder up and down. And then you're marking how important those steps are. Maybe you're the guy who's going up the ladder can get every other rung, or you're like me who's petrified of climbing down the ladder, so I make sure I step on every step coming down. But these levels are made up of prior traders' actions. So in other words, one group of traders bought at support and are going to sell at resistance. So you had traders who bought here, sold here. But then you had other traders who entered here, okay, and got trapped in the market when it fell down. Now it didn't fall, it didn't reverse its trend, but they entered too late, so they ended up losing money and probably got stopped out. But if you think about how a market makes these steps, in order to push a market up, traders have to be, for some reason, jumping into the market, and they're pushing and pushing and pushing that market upward. At some given point, some of these traders who haven't entered the market but are watching it, they move over to the sidelines because they just say, you know what, that price is too high right now. They're still interested in buying, but it's reached too high of a price level at this point to buy. They have other ones who bought down here and down here that are selling at their profit now. They're happy. They made their target points. They made their profit. So they're selling, and these guys are on the sidelines. That's going to let the price ease down a little bit. As it eases down, these guys are on the sidelines start coming back into the market. And what happens is it pushes it up to make the next step. So it makes the next step up, keeps going up, 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 comes to a significant price level. And these guys who are in the market say, oh, guess what? It's time for me to book my profit. He's happy. I got all that profit. Start selling. Price eases down. And the guys that were sidelined said, you know what? I'll enter the market at this price to trade it to go back up at least to that resistance level. So that's another way that we form the support and resistance levels. Now, what we have to remember is, and this is crucially important, one thing to remember is that support and resistance levels are not exact numbers. Oftentimes, you see a support or resistance level that appears broken, but soon after you find that the market was just testing it. With candlestick charts, these tests of support and resistance are usually represented by the candlestick shadows, the wicks above and below. Like you see here, this was a significant support level drawn on our charts from way back when and brought forward. Now, as price is declining, we see that the support level is holding, but the lows broke it, but the body of the candle was never able to come near it or go up. So that means that the price was supported by that support level. And these candlestick wicks going through, but the body never making it, actually make this a more significant price. So as we saw price run back up again, tipped back down, and what happened again? It came to that support level and couldn't break it and bounced off of it again. Well, you could make some good evaluations for trading. Now, there is no rule that it couldn't come down and go right through it again. There's no guarantee about anything. It's not like they're putting up a fence that the price can't get through. Now, support and resistance is common jargon for areas on a chart where price has had a difficult time breaking through. Support levels tend to stop price from falling below a specific level, and resistance levels act like a ceiling that price cannot break above. Doesn't mean it can't go above, doesn't mean it won't go above, doesn't mean it won't go slightly through it and come back down underneath of it. But it gives you as a trader a point of reference on your charts and a point of reference for your price decisions. Knowing where these levels are make it much easier to decide when to open and close trades, and how we can. So the question is, how can we locate these to begin with? Well, one of the ways is to find previous swing highs and swing lows in the markets and draw some lines connecting them together and projecting them in the future. And support and resistance levels, especially historic ones, stay valid forever because they only help you when they're around the significant price. So even though we drew this one on our charts here, price is trading all the way down here. So it's really not going to help you unless price turns around and moves way back up this way. But it can be projected on your charts because sooner or later price will come back to that area. So for us, this is a resistance level, a support level, because look, when price was falling, this is the bottom of where all these swing lows touched, but weren't able to get through. Now, it didn't really hold anything right here, didn't do anything for us, except price broke through it, wasn't able to go into a continued downtrend, bounced up and came right above it again. So it helps us look for a reaction. But once we saw it broken at this point, I would wait for the next two candles to make any decision. But it gives us some idea of where to expect or where to evaluate price. Now, arguably, the easiest support and resistance levels to add to our chart are pivot points. Now, pivot points are mathematical calculations. They come from what's called a pivot point calculator. And you can either look for a pivot point chart or you can find, like at investing.com, a pivot point calculator and you fill in the information. You simply fill in the open, the high, low, and close, and it'll do a set of calculations for you and give you the three levels above and below the current price that could be significant in the move up, above, or below. So, like, these are known floors on an elevator. Okay. Market ebb and flow. They go up and they come down and they move sideways. The primary ways we make sense of these movements are analyzing the price action as well as the levels in the market where price bounced higher or rotated lower. We call these levels support and resistance. Support and resistance levels form the foundations of technical analysis, and they help us build a framework from which we can understand the markets. For price action traders, support and resistance levels help us maintain a plan for our stop loss and our target points. But perhaps more importantly, these levels give us a way to make sense of the market in terms of what it has done, what it is doing, and where it might go next. So one of my favorite ways of getting support and resistance are using, like I said, dynamic support and resistance. That's using moving averages. When you put a moving average on your chart, whether you're using a 10 period, a 15 period, a 30 period, when price stays above that moving average is acting as support. When price tries to break through it, it's and it's going down, it acts as resistance. Then we have retracement levels. So whether you're using Fibonacci or the 50% retracement from Dow theory, these are certain levels based on the prior move. So when an asset was trading at, say, 0 and moved up to 100, we can expect as it declines to come down to the 50% level and bounce off of it. That's a retracement level. That retracement level is therefore a support area. And then my favorite way of finding this is called eyeballing. And that is my favorite because two reasons. It makes you work directly with your charts and it makes you see how these historic prices are important. So let's jump over to a live chart. Now, because price moves in and out of support and resistance areas, you can see this red line across here. That's a prior support. Let me say some was this red one up here. These are lines I had drawn on my chart ages ago when price was trading in these ranges, and I went back historically and looked at how price and look for where price hemmed in the past. Because all that's important are the prices around today's price, but price will eventually move back into those ranges. So today, okay, prices are trading here. So what we're going to come on here and we're going to draw two lines on our chart. And we're going to put one right under where price is trading today. Okay. We're going to leave that gold and we'll make it big and thick. Okay. And then we're going to go slightly above where price is trading today. And let's put another line on here. Now, these are not our support and resistance levels. I'm going to show you what they are. Okay. They're insignificant lines, except as we go back in price, we can't see where the current price is, but we can see where our lines are. And that just helps us identify, because what we're looking for is when price in the past traded in these interim periods in between the gold lines. So we can, back in the 24th, 25th, 26th, prices of gold, prices of the euro were around that price. We could look for a significant price level. So here we can see that this price, and we're going to make this blue. So we're going to see this price was important. We see all the bodies in the candles, the wicks all touching that price. Okay. Do we have another price above? No, not really. Okay. Now, the other way we can look at this, we can go back to longer term charts. So if we take this back to a 1 hour chart, we're also covering a longer, but our gold lines remain on there. So we can continue looking for these zones, because we just need the gold reference point as we go back, because we can't see where price is currently. So in other words, when we look here, the euro has stayed well above the range that it is trading in currently, and that's why we don't see any of our gold lines. Or do you mind just cut the charts? Hold on a second. Down here, come on, there we go. Look at these prices right here. We had all those important lows right there. So we put that on blue, because blues are just what we're looking at currently. Can we see? Look at this. Look at the tops right there and all along here. And this is a big gap in time, but we can see how important this price was here, as well as, almost a month later. So as we move forward in our charts, our time frame, and now we can see the blue lines. We can get rid of the gold lines, because they serve no purpose except in helping us identify these levels. Now we have to find a bottom support zone, and we don't have anything historically that goes back to this. Euro has very rarely been this low for a very long time, back at the 109 range. So we got to keep going back till we can find the euro trading somewhere significantly around. It's trading all the way up here at the 110 levels. But the only thing that's going to help us now is something at the 109 level. And like I said, we're at a very, very low price. I think it's hit 108 a while back, but that's very rare for the euro. See, it's all the way, it's a 110.68. Okay, so here was the last time we had the euro. And to be honest with you, we don't have anything significant. There's no price in this range that we see that we can actually draw a line on. We'll go back a little bit farther. Let's actually see if we can go back to a 1-day chart. Hmm. Nothing really significant because it's making a new low. So we have the ranges we put on our chart. 1-day, 15-minute chart. Okay, so now we've isolated these, but we've isolated these by dealing and working directly with price. But now actually, if we look at this, we do see a level that might help us. And we colorize these levels because we want to know which are majors and which are minors. So let's see, this one is short term, but it's an important level. But it's right where price is right now. So price is holding that. It's not been able to break through this 109.2026. So if price bounced off of it, we might expect price to bounce up and move here. We might get a reaction here, and here we would hit our next resistance level. So this is how you can eyeball price. Now, all of those other lines aren't wasted. They're valuable because they continue forward into the future. And when the euro starts moving back up, those lines will come into play again. Now, the other thing is we can drop on here a moving average. Okay. And we can use this moving average. It's in gold. And here, price is staying below the moving average is tending down. And we would expect it to come up to resistance as it bounced back to that support level. Okay. Now we can see the moving average moving above this support level and price staying above. So it's giving us more information. It's giving us at this price level is significantly important when the moving average crosses the support level. So there's many ways to get support and resistance. I use strictly eyeballing. It is my favorite way, and then I might combine it with a moving average line. But I think eyeballing, because eyeballing isn't a rule, it's not a calculation, and it allows you to use your personal understanding of the markets and your personal research to outsmart the other guy who's using his. And it gives you, because you're working directly with price action, it makes you more involved with the markets. Now, I'm going to share with you a rather monotonous presentation on how to do this correctly. It'll go pretty fast, but it will show you step by step so you understand how to use swing lows and swing highs and project them forward in your calculation. So let me share that with you. And then we're going to go back and talk about how to use these in your trading. So if you notice, one of the most important things is using historical price action. And the longer the time frame and the more times the prices hit that level, the more important it is. But once you've put those on, they continue forward. And then when you adjust your charts to a smaller time frame, they hold as valid, and it gives you specific ranges. Now, what we did in that video is we found zones, because since support and resistance is being eyeballed, okay, and you're doing this as an estimated price because it's not a numeric value. It's just a price where price is a level where price is hemmed and hawed in the past. We do this with zones, and then these zones become above and below that zone are very strategic numbers. And then, because like I said, the lows might go into it, or the body might fall into it and then bounce right back at it, we don't panic at that specific level. We'll see a lot of times where price will fall into that zone and then move back up into above that resistance and support level. But now that you know the basics, it's time to apply these basics but extremely useful technical tools to your trading. We want to make things easy, so we divided some basic strategy into to trade support and resistance into two simple ideas: the bounce and the break. So the bounce, as the name suggests, is one method of trading support and resistance levels, is right after it bounces off of one of these zones. Many Forex traders make the error of setting their orders directly on support or resistance levels and then just waiting for their that trade to materialize. Well, since we're actually calling them zones, not a specific price level, we want to wait for it to come into that zone, hit the zone, maybe play in and out of that zone. And then when it bounces off coming out of that zone, that's when we would want to place our trade. But we don't want to place our trade exactly on that number. So, sure, this may work now and then, but it won't work enough to get you along in the head. So, what you want to do is you want to wait for price to come down to that price zone and then bounce off of that support level. But you want to wait for it to strategically bounce off of that to return into its current uptrend or downtrend, and then enter an order. And you want to place your stop loss a few pips below that support zone. So if you have the zone built in there, you'll place your stop loss below the bottom of that zone. And this is called trading the bounce. Now, there are more significant ways you can combine this together to make a more solid decision. Seeing volume increases it bounces off a support level, or looking for indecision candles. But you just don't want you. This will help you set up an order, but you need something else to trigger your order to say yes, that's a good order. And again, a change in volume will help you see that. So the bounce, if you're looking to go short, you will wait for it to bounce off resistance before entering and just do the reverse. And then the break is, in a perfect world, support and resistance levels would hold forever. McDonald's would be healthy for us and we'd all fly around with jetpacks. But in a perfect forex trading world, we could just jump in and out of whenever price hits those major support and resistance levels and earn loads of money. But the fact is, the matter is, price breaks these levels often. So it's not enough just to play the bounces. You should also know what to do whenever support and resistance levels give way. Now, there are two ways to trade it, either the aggressive or the non aggressive way. But either way, you have to be prepared for when price goes through. Now, price often breaks its support. Okay. When it does, it's giving you a significant heads up that you could trade. But doesn't mean it's not going to come down three candles in reverse and come right back above that. So you still need other confirmation tools. Okay. Again, volume would help. In this case, indecision candles. I always wait for the formation of the third candle. So one candle will break that support level. The next candle should form, the body should be underneath the support level. And if the third candle is forming and going down, then I would enter the sell trade or the sell position. But there, you have to be conservative. Now, a conservative way is you would wait for price to bounce through the or break through the support level, bounce back up to that support level, and then parlay off of that and enter when it comes back down again. But it's virtually the same either way you look at it. I look, like I said, I look for multiple candlesticks and I look for volume to tell me what to do. But there's many ways to use support and resistance. Now we've gone over the major types of support and resistance and how I use them indications of the market. Now on the ETX platform, you can just click on indicators and it'll put on support and resistance. But what it puts on there for you is pivot points. Okay. Eyeballing isn't done for you automatically by anywhere except by you. Okay. Fibonacci tools, Fibonacci retracement tools will give it to you, and that can be just dropped on your platform and pulled over the prior move. Okay. A 50% retracement level is easy to put on your platform. But again, swing highs, swing lows, or eyeballing is very important. So when you combine a solid understanding of support and resistance levels with price action and market trend, you have the triumvirate for trading successfully. So support and resistance doesn't have to be confusing. We can mix and match any of the methods to create a healthy amount of price levels that we can always trade. As always, practice makes perfect. So make sure you test out these methods using a real-time demo, and you have everybody with ETX has an opportunity for a demo account. Just click on it and try them out and get to know them, and then move them over into your everyday trading. So thank you very much for joining us tonight. Thank you for being part of the ETX family, and we'll talk to you again real soon. Good night now.